So the organisers said, would you mind doing a presentation? Yeah, no problem, of course, anytime. Would you do a workshop? And I'm like, I'm not really sure what you mean by that. So what I said, I'll tell you what, I'll just do like an extended Q&A session. If people have questions about my presentation or about designing trading strategies or what my favorite breed of dog is or whatever, then they can just ask them and we can hopefully get a conversation going about fitting and design first and machine learning and whatever you want to talk about. So the floor is open to you guys. This guy first.
Yeah, so the question about fitting the risk for your strategies or your strategy for your results. I like the way you showed like your models, but some of them will be in a drawdown or a losing curve, but you still run it, but allocate smaller risk proportionally. So the question is how to know at what point allocate less risk in those portions and at what point allocate more risk on the strategies that don't do well.
Okay, so the gentleman has very nicely asked a question about the very last slide of my presentation. So I'm going to spend the next 5 minutes getting repetitive strain injury. So the question basically is, I guess you could rephrase this question as, when do you give up? Like when do you just think, you know what, this thing is a piece of crap. We're still being recorded and live streamed onto the internet. Okay, I'll try and tone down my language. When is this thing total garbage? So I guess there's kind of two different ways you can look at this. One is to look at it in a theoretical sense. So essentially, as you go through time, you move through time, you're discovering more about your trading strategy and what its return distribution is. And you're hoping the return distribution is positive, has got an average positive value. And of course, you never know. There's a big assumption here, which we make in quant finance all the time, which is that the return distribution of whatever is kind of stable and will continue into the future in the same way, but we just don't know what it is. And we kind of discover more about it over time. Yeah, so that's kind of the implicit assumption we make anytime we do any kind of quant finance work. So at the start of this backtest, we know nothing about any of these lines. We know nothing about the distribution. Then we gradually learn more and more about them. And we get more and more information about them over time. So one way of doing this is to, in a very kind of formal sense, to look at the distribution of returns that you get over time, and then to say, conditional on that, what is the probability that this thing actually is losing money? There's well-known techniques of basically saying, given a particular series of returns, what's the probability that the real return, which we can't actually see, is negative? So like one formula that I remember off the top of my head is that the distribution of the Sharpe ratio is the average Sharpe ratio plus or minus, and let's say you want to get like a 95% confidence interval, right? So you want to be 95% sure that the Sharpe ratio lies in a particular range. It's plus or minus, so it's the average Sharpe ratio plus or minus 1.96, which is kind of normal distribution number, times the square root of 1 plus a half the Sharpe ratio squared divided by the number of samples. So, you can use a formula like that in theory to basically say, and it'll give you a hard answer. It will say, like here, it will say something like, there is a 70% chance that the pink line is garbage and has a negative, the return really is negative. Yeah. And it might say that there is a 75% chance that the yellow line is good and probably has a positive return. The question then is what you do with that information. And actually, I wrote a blog post on this subject quite recently, and I call it the uncertainty premium. So basically, how certain do you need to be before you do something? And that sort of depends on what your, so if you know about like Bayesian statistics, what your prior is. So what do you, without any evidence or information, what do you think about the pink and the yellow line before you start? If you really love the pink line, it might take quite a lot to shake you from your foundation that doing the pink line is a good thing. you might say, well, actually, I want to get to the point where I'm 95% sure that the pink line's got negative return before I stop doing it. Similarly with the yellow line, it might be that you were quite skeptical about the yellow line, and it takes a long time before you think, actually, this is a good thing. So to take a real-life example, if you look at something like Bitcoin, I have a prior that investing in cryptocurrencies is just a stupid idea. But on the other hand, if the thing continues to go up, it goes up by 100% a year, like for 10 years in a row, at some point, even the most, at some point you've got to say, well, the evidence strongly suggests that this thing is a good investment, purely based on the return series. But my prior of how sure I have to be about that would be different from somebody who started off loving cryptocurrencies. So that's one way of doing it. The other way to do it is to let the portfolio optimization do it for you. And what a good portfolio optimization will do essentially is do what I've just described. There's kind of two broad churches about how you do this. So one is bootstrapping. And with bootstrapping, essentially, you kind of shuffle the returns from the past. And what that does is basically, if there isn't strong statistical evidence that all of these lines are different, then you'll end up with something very close to equal weights, because you've basically got no information about what's better and what's worse. And the other way of doing it is to use the kind of normal portfolio optimization, the Markovits, if you know this stuff. And then basically what you do is you adjust the inputs to reflect the amount of uncertainty you have. And what that will do is right at the start, it'll give you equal weights. And as you get more information, you basically allow the data to influence your results more. So they kind of have the same effect. So essentially, human beings tend to overestimate statistical significance. So most human beings will look at this graph and say, well, clearly there is very strong evidence that the yellow line is different from the pink line. Extremely strong evidence. But actually, if you actually worked out the probability, it's not as strong. It's not like there's a 99% chance the yellow line's better than the pink line. It's probably about a 70% chance. And 70% for me is not enough to completely drop the pink line and invest only in the yellow line, for example. And a good, robust trading strategy fitter would take the same approach. So it would be down-weighting the pink line relative to the yellow line, but not completely to zero, because you actually need quite a lot of evidence, unless things are really, really, there's a huge difference in returns, which you rarely see in real data. I'm going to go to Vin next.
Well, if you were just naively to apply Markovits, it's possible that it might not give us negatively.
Yes, so if you were to apply naive Markovits, so naive Markovits doesn't know about uncertainty. So when you apply the Markovits formula naively, essentially, it would give you the same results. It assumes that a year of data is as good as 30 years of data. So absolutely, yeah, a naive Markovits wouldn't account for this properly. But I'm saying I wouldn't do that. I would take techniques that fix Markovits in that respect. So, yeah.
And you'd never have negative weights?
As it happens, I normally constrain it so that I love that he's answering questions he already knows the answers to, but but basically I take the view that I wouldn't short a trading strategy. So if a trading strategy is losing money, and it's losing money in a statistically significant way, unless it's because of costs. So it might be that these are actually all pre-costs, but if something's losing money after costs, well, you just don't trade it because it trades too quickly, clearly. The effect that you think is there does not survive paying trading costs. It only exists in frictionless markets. But if the trading strategy is not working because your original idea was stupid, potentially then for me, you're essentially moving from an ideas first to a data first world. You look at all of your data, see that idea X that you thought didn't work actually worked so badly you'd want to trade minus X. Well, that's implicit fitting, right? You've essentially gone back and said, oh, well, originally I thought for very good reasons that this would work. It turns out that doing the opposite works better, so I'm going to do that instead. Well, that's an implicit fit. I'd avoid doing that. And the way to translate that into the allocation of risk in terms of saying, should I put money in the pink line or not, or short it, is to say, actually, the weights are floored at 0, so I never short the pink line. There was a question over here. Was it you? Yes.
Two questions, one very quick one slightly more detailed one. Quick question is, why do the orange and purple 10 to 14 start halfway out the...
Yeah, so I think I did mention that briefly in the presentation, but basically these are the fastest trading rules. It's 10 and 40. They only get allocated to by certain instruments that are quite cheap to trade. And those instruments, it so happens their time series doesn't start till 1999. That's the reason why. And your second question?
Second question was, so you talk a lot about design and having tacit understanding of markets first. So we've created this trading system during previous lecture, and we said, okay, well this seems maybe tradable in the market. Now the next step from that, sort of what does Rob Carver do as the next step? Because the temptation is to go back to the beginning and say, well, I can create a better version of this model. I mean, do you just push this out to the market now and sort of say, well, it's satisfactory? Or do you sort of go back and say, well, instead of OLS, I'll try GRS?
Yeah. So there's different ways. So one thing that I think is okay to do is to say, I've tried OLS. I'm now going to try, let's say I want to stick with regression. I'm going to use, generalized method of moments, say. If you don't understand what I'm talking about, don't worry. It's just another way of doing the same thing. I'll come back to you. And then I'll take the results from that and push that along with this into my big risk allocation strategy, and then essentially in a Darwinian way, see if that continues to be allocated to. I think that's okay. I think what you described before probably is I would be uncomfortable with doing. And the other thing to bear in mind is that I haven't talked about it very much, but remember I said that you can't necessarily statistically see a difference between the returns of these curves. The same would be true of doing a trend-based system, regression trend-based system using OLS and GMM. They would give results that might look different to the human eye. When you actually look at the statistics, you wouldn't see a statistical difference between them. And that means you wouldn't actually choose one over the other. And you should basically do both or pick one at random. Because adding extra lines on my graph is free, because everything's automated. If I was manually staring at charts, every time I came up with a new indicator, I had to look at it on a chart. Well, clearly there's a limit to how many indicators I can look at. Because adding indicators is free to me, because I'm fully automated, I would in practice just add it to my model. And over time, you just accrete more and more of these things.
Is that not a variant from the black box model? You just trying very, very hard.
That's an interesting philosophical discussion, but I personally take the Lego bricks approach to this, which is that each of my individual models is very, 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 very simple indeed, and I can understand it. And I then aggregate them up in a linear way. That means I can perfectly decompose and go from my final signal back to any of my individual signals. So my transformation from, I've got lots of simple things, I combine them in a simple way, and I end up with something that might be unintuitive, but I can always take a step, can always go backwards and say, why is my system long here? Well, let me look at the individual signals, and then I can understand how the individual Lego bricks behave. So the alternative would be to fit something that effectively had the same number of degrees of freedom as that Lego brick system, the same number of kind of moving parts, but to do it in one big go. I personally don't like that approach, firstly from the fitting perspective, and secondly, I wouldn't find it as intuitive, even if it ended up doing exactly the same thing. This chap here asked the question earlier.
Is machine learning useful in trade forex system and why?
So I personally think if machine learning has any useful applications in finance, it's not going to be in rediscovering something we already know works. So we already know that trend following works. We can describe dozens and dozens of relatively simple ways of capturing trends. They all produce very similar performance. Like I said, I wouldn't necessarily pick any of them outright. If someone basically ran machine learning over a data set and came out with something that, and it would be hard to tell maybe because it would be complicated, but came out and said, oh, trend following works, I'm like, well done, you just burned an enormous amount of computing time to tell me something I already know. It's more likely to be in a totally different domain where you've got maybe higher frequency data and there's some weird nonlinear pattern that kind of a that no one's been able to see before because they've, not had. First of all, it needs to be a weird nonlinear pattern and persistent so you can trade it. So it's going to be quite a small set of things, but potentially they do exist. And then it's only because you've been able to bring machine learning to the party that you can identify that pattern. Guy in front with the diesel top on.
Just aside from the charts and all that, so how do you manage your time, like your process, strategy development process? Like how many strategies you want to live? What's your daily type of routine?
Crikey. I'm running about 10 types of rule. I spend 0 time on strategy development. I basically, when I retired, 5 years ago now, I spent about 6 months developing my trading system, and I stopped because, and it seems like a bit of a weird thing to say at a conference like this, but I don't actually necessarily enjoy the process of creating new trading strategies as I enjoy other things. And my system just runs by itself. So it's fully automated, so it's more of a housekeeping. I probably spend about 5 minutes a day just checking the computer's working. Every now and then, I might upgrade some code or fix something, or one of my kids has tripped over the router, or, So in terms of managing my time, I don't really spend very much time doing this kind of stuff. So maybe a more sensible question is to say, when I used to work in hedge funds, how did I manage my time, strategy development, and so on and so forth. So probably, it's hard to define what a new idea or a new rule is, but you're looking at maybe 1 or 2. So Vin can nod or shake his head because we were working at the same firm, but maybe 1 or 2 good ideas a year would be good. And you probably spend quite a lot of time looking at data and making sure your data's good. You spend a lot of time in boring meetings, as you do with any job, particularly when you're in management. The amount of time you spend staring at graphs like this is quite a lot, but let's say you spend an hour, 10 hours evaluating a trading strategy. I'm not saying you would spend 10 hours, but 10's a useful number to work with. You'd probably only spend half an hour of that looking at the outright performance, and the rest would be looking at the behavior. And that's maybe one of the things that distinguishes kind of retail and sort of more professional quants. So you would be looking at things like, the trading patterns and the risk, I'll come to you, and the leverage and stuff like that. Does that give you some insight? Or?
Yeah, just one more thing. So I'm a professional software developer. That's my role my day-to-day, and I'm kind of hobby it the last couple of years consistently. Would you recommend going into a financial company, into a hedge fund, trying to change tack and move into that direction?
And didn't Andreas just give a talk about that?
No, so you guys work at hedge funds. It's kind of what I'm getting at. To really get into this, you think that it's necessary to move in that direction with a financial firm, learn the skills?
It's a massive head start, I would say. Like the stuff I know about trading and systematic trading and statistics and all the stuff I know would probably take years to learn, like if you were self-taught. And you'd also need to know where to look, and a lot of it's secret, So, yeah, it depends what your end goal is. It's quite nice if you really enjoy this stuff and you can find someone who'll pay you to do it. I don't see why that's a bad thing. Chap at the front.
Yes, one of the myths or truisms maybe floating around this industry is that the more successful a strategy, the less its lifespan. Is that your experience, or is it possible to have very successful techniques which go on working indefinitely?
So I don't think it's a myth. I think it's just common sense. Partly it's common sense, partly it's economic theory. But basically, economic theory says that if you have an industry where supernormal profits are being made, other people will move into that industry and take them away from you unless the industry is protected by regulation, say. So the kinds of stuff I look at is relatively low frequency. There's a relationship between how fast something trades and what the kind of maximum possible profit is. So trading with a holding period of a few weeks or months, you're never ever going to be able to make the kind of money that a high-frequency prop trading firm could make. It's just not theoretically possible. You know, like Warren Buffett, we were talking about Sharpe ratios a bit earlier. Warren Buffett's Sharpe ratio is 0.7, and he's probably the best kind of long-only investor in the world. The Sharpe ratio of a high-frequency fund is low double digits. You know, so it's order of magnitude bigger. There's basically you continuum. At one end, you've got things where they trade quite slowly. There isn't that much money in them. And there are things that have been around for a long time and will persist. And I would put trend following in that category, and any, you know, carry and, you know, equity value and that sort of thing. And then at the other end of the spectrum, you've got things with very short holding periods where the theoretical profitability is very high, but the performance is likely to decay quite quickly. So if you're talking, you might be in a situation where you find an effect that's existed for, say, 2 months. You find it within a week, and you might then have a month to exploit it. And then the whole cycle starts again.
But why?
Why? Because then...
It's obvious to the rest of the market what your strategy actually is.
Yeah, but there's no like magic machine that some guy has that will find... Okay, there isn't a generally available magic machine that you can get that will find strategies that make a lot of money that no one else has access to, right? That doesn't really exist. If it does exist, there's maybe 1 or 2 firms that own it, Renaissance Technology being the first one that comes to my head. And that maybe some of the stuff AQR does. But generally speaking, we're all using the same tools and techniques. The high frequency guys are in an arms race with latency and computing power. It's not like you can buy some special machine learning application that will find stuff. You know, people are trying things with alternative data and stuff like this, and maybe there'll be a bit more longevity in that. I'm a bit skeptical of it. But basically, you know, if an effect exists that's highly profitable, someone else will find it sooner or later. That's just life, and that's happened, you know, that's what will happen. And the more profitable it is, the faster people will find it, and it's more likely to be a high-frequency trading strategy because they've got higher theoretical Sharpe ratios. So you've got 2 options. You can either play that game, in which case you need to be spending going back to your question, you will spend your whole day trying to find new ideas because you've got a month before your entire business model collapses. So not 1 or 2 ideas a year, heck, one idea a week, minimum, preferably more. Or you can do what I do, which is say, well, this stuff seems to work for a long time. It doesn't make that much money in the grand scheme of things. I mean, none of these account codes are brilliant, right? Most of the benefit comes from diversifying across a lot of different things. It won't work for several years at a time, potentially. In my trading account, I haven't made money for like 2 years. It's been totally flat. My investment account, fortunately, has made money, and I send my wife out to work, so, you know, we're still okay. But you know, you need to be able to cope. If you either cope with a 2-year flat period doing this kind of trading. The good thing about it is it involves almost no work, like I said, because you basically say, here are the effects I want to exploit. Here's a system that does them. You know, there's almost no value then in revisiting those things. In the fund, we used to do it. We used to refit our models every year. It was kind of, to be honest, you know, when you've got 40 years of a 40-year back test and you add 1 year to that, that 1 year is going to make almost no difference to your parameters. So, you know, why bother? You've already asked a question, so I'm going to go to somebody else if that's okay. The chap in the T-shirt.
Say a little bit about factors that go into determining what universe of instruments or assets you will end up trading. And specific to that respect, is there like a robustness test for a strategy that you apply that it needs to work across multiple instruments or various asset classes, or can you kind of reverse fit strategy to the instrument?
Okay, so in terms of instrument selection, generally, so I'm going to answer your question backwards slightly, but basically, if you look at the performance of these things across instruments, and then you add like error bars to show you the statistical significance, I'm actually currently in the process of writing yet another book, I'm afraid, and the figure 1 is this chart, figure 2 is this chart, and basically it shows that for a given trading rule, you normally can't distinguish between the performance of different instruments with ignoring costs. So I would be, yes, I would, to answer your second question first, I would be very reluctant if I had something that only worked on one instrument, definitely. In practice, that I don't normally find that. And the reason I don't normally find that is I don't overfit. I don't like fit things specifically to individual instruments. So normally it's unusual. Unless, you know, there are things that only work with certain instruments because the economic intuition behind them, it doesn't make sense otherwise. Like, so for example, you can make quite a lot of money just by shorting the VIX and the V2X. Although the skew, going back to Arta's presentation, the skew is really ugly, but you're kind of being paid for that skew. There's a premium to earning skew. But I wouldn't run that strategy on, I don't know, corn, because it makes no sense. So then in terms of instrument selection, if we rule out the fact that we're looking for things that make money for a given strategy, and we rule out the fact that we're going to generally start tuning strategies for instruments, there's two factors you tend to have to play off, and that's, as a smaller investor, the kind of size of capital you have to commit and the costs. So the cheapest thing you can trade is pretty much the S&P 500 future, but you need at least $200,000 to do that. You can trade like, I don't know, Aussie dollar spot FX with, I don't know, £50. But with a broker like FXCM, I'm sorry guys, I'm not going to lie. I may never get invited to this conference again, but the fact is that trading spot FX through retail brokers is very expensive, but it has a very small account size. So you're kind of usually trading those two things off. People with more money can afford to usually trade more cheaply up to a point. The point at which they're trading impacts the market. So in terms of instrument selection, I'm looking to trade a wide variety of instruments. So I've got good diversification, and then I'm picking things that aren't too big, and I'm picking things that aren't too expensive. And then in terms of adapting my strategy, the one adaptation I will generally make is I will put things that are expensive, I'll trade more slowly, which means in this space that they've got more allocation to the bigger ends.
So implicit to your answer is that in general, multiple instruments will trade in similar fashions, apart from...
Yes, unless there is strong statistical evidence, so you shouldn't do that. And the nice thing about using this kind of framework is that will tell you where that's the case. So, for example, there are some effects within the fixed income markets, and different things seem to work differently. I did a blog post about it, but the short end of the curve and long end of the curve seem to behave differently. In terms of carry and trend allocation in different regimes. There are things there, and they're just on the verge of being statistically significant. But there aren't many of those things around, so generally you just don't bother doing it. This chap.
Interested to know, if you look at firms like Winton, AHL, Bluecrest, managing money, how the returns are very similar. So they're obviously trading at trend following. When you look at some of the other masons who are miles ahead, how is it that these three firms here are such smart people? They haven't thought about trying to get out of the trend following, because I know over time it does return money, but as you said, the last couple of years, trend following.
So there's a few reasons why. One reason why is when you're in an institution, people want to style box you. So if you've got $20 billion from trend following, from running a trend following fund, and you then go to your investors and say, hey, I've decided I want to do options arbitrage, they'll say, that's really lovely. Can we have our money back, please? You then need to go out and find a whole new set of investors who are prepared to invest in you. And really the only, you've got a slight advantage in that you're demonstratively smart and you're good at one kind of quantitative trading, but that doesn't mean that you can just step into something else. So for example, what you have to do, and what AHL has done actually reasonably successfully, is start a new fund, a new vehicle, and then get new investors into that and say explicitly up front, this vehicle is for stuff that isn't trend following. And if once that attracts a track record, then you can probably do that. And there is a vehicle, there's a couple of funds within AHL that aren't doing traditional trend following that are very good. One's called Evolution, that's still doing trend following, but with non-traditional instruments. And that's been one of the best performing hedge funds for the last 7 or 8 years. So the other problem is that It's really quite hard. You can't just turn around and say, I mean, it's like saying, like, I'm a kind of okay cyclist. So I do quite a bit of cycling, which is one of the advantages of not, having a proper job. But you can't just say to me, hey, why don't you be more like Chris Froome? It's, it's not that easy. It's not that easy to just do what Renaissance are doing, because, there are certain firms who you probably could look at what they do and say, actually, it's fairly well understood what they do. I could probably go and build something that does something fairly similar to them. And almost, there are, 99% of hedge funds you could probably do that for, I would say. But then there are a very small number that are doing something different and making consistent money. And the fact that it's so hard to do that very different thing, just means that it's very difficult to do. So to just say, oh, why didn't you go and do that instead, is quite hard. Yes. Oh, go on then. Yes, thank you, Ben. Good point. Yes, so just to repeat for the benefit of the microphone, Renaissance actually tried to do the reverse. They looked at what we were doing, the trend following space, and said, oh, there's $200 billion of capital here, we should have a share of that. We've got this great brand name. And then they launched a fund that basically tried to do what we did. And it was, did pretty badly, actually. So, then they went back and stuck to what they do well. So it works both ways. I think you were first. I don't understand.
So, like, many strategies, and through a back test, you'll kind of change the allocation.
Yeah.
So that is actually a strategy in itself. Right?
I suppose so, yeah.
And then, is it better to do something like that, or would you rather just output the balance, the correct balance, or the desired balance?
Yeah, so in light, I'm not sure, I think I'm going to try and answer your question, but I may have got it wrong. But basically, during the back test, the risk allocations to different things is changing, and it's all done, this is the only fitting I'm doing, so it's all done on an out-sample basis, blah, blah, blah. Then at the end of the back test, we say, right, what are we going to implement in live trading? Well, in practice, what you do is you take the weight, the last set of weights, and you implement that, basically. And then you could, refit them every year, but like I said, I think that's a pointless exercise unless you introduce a new market or a new trading strategy into your system. And then in live trading, you're essentially running with fixed risk allocations pretty much. I have looked at dynamic risk allocations, and it's kind of a big thing that people like to think works, but it doesn't work that well. Cliff Asness has written quite a lot of stuff on this that's really worth reading. There was a question here, yes.
You mentioned a two-year flat period recently.
Yeah.
At what point does Rob Carver think I need to actually review those strategies? Or is it the fact that from an economic standpoint, using an ideas first approach, that flat period makes sense to you and you can understand the performance?
So the first thing to do when you have a flat period or a down period when you're trading is to say, did I expect this to happen? So the nice thing about having backtested strategies is you can say, well, historically, how likely is it that you have a 2-year flat period? And this actually is, my real backtest is a bit better than this because it's got a load more strategies in it. But, you can see there are quite long periods when you don't make money. So then you shouldn't be a surprise to you then that you don't make money, basically. In fact, the reverse can be true. So I know a guy who started trading, basically cloned what I do, which is fine because it's all in the public domain. And the first year he made a lot of money. And he thought, I'm a genius. Stuck a whole load more money into the strategy. And then then he basically caught the beginning of the flat period, the same flat period I've been in. He was kind of banging his head against a wall because he's literally read everything I've written, and he's like, God, I know you write so many times about statistical significance and uncertainty, and the fact that you just don't really know. There's a lot of randomness, but I got carried away with the fact that I made a lot of money in the first year. Now, if you have a 5-year period in which you're losing money and you lose half your capital in 5 years, well, that shouldn't happen. That's never happened before. And if I was to do this quantitatively, and I'd look at there's a way I could look at my backtest and say there's only a 1% chance this should happen. So I'm in a 1 in 100-year bad event. I mean, I'd probably at that point pull the plug, you know. But that, you know, touch wood. Is that wood? It's kind of wood, isn't it? Touch wood. That hasn't happened. So I've forgotten who was next. There was a chap right at the back who was first.
I was going to ask.
Well, there was even behind you. There is somebody else. Sorry, you're too far away. I'm going to come closer.
I hear some senior traders say that trading strategies expire after a while.
I'll refer you to the answer I gave to the other guy. So the less money there is in a trading strategy, the longer you should be able to run it before it expires, in my opinion. Now the chap who's a bit closer.
Yeah, I was asking if either way you found any significant difference between using ordinary least regressions as opposed to penalized regressions.
You mean with this specific strategy? To be honest, I don't actually use, in general. Well, what are you using the regression for? Because here we're using regression in a pretty dumb way, which is to say, is a line going up or down? There are much more sophisticated ways that one can use regressions in quant finance.
Yeah, I think the whole idea of penalized regressions can be outliers.
Yes. Yeah, I mean, in this application, it would make almost no difference because the way we're using regressions is kind of pretty rudimentary. But yeah, if you were to so you can use regressions for this exercise, right? You can try and find the best weights to allocate to different trading strategies. And yeah, I would use penalized regression in that context, definitely, especially if the underlying returns are quite noisy, you've got big jumps and stuff, you don't want to over-allocate to things like that. Yeah. No. I mean, using a standard regression to allocate weights is pretty stupid because it will tend to give you extreme results. You'll put all your money on yellow or something like that. So you do want to use, in the same way that, going back to Vin's earlier point, naive Markovits will do stupid things and put all your money on one asset. So you absolutely shouldn't be using those things if they do stupid things. You need to use alternative techniques like, so in the portfolio optimization space, like bootstrapping or Bayesian stuff, and in the regression space, something like lasso or penalized regression or whatever. Otherwise, yeah, you'll get random results. So yeah, it will absolutely give you a bad outcome if you just do a simple regression. In this particular context, yes. Next question. I'm going to go to you. I've forgotten your name.
Mike.
Mike, of course, Mike.
Which techniques within machine learning or AI do you think are likely to be able to sort of scan and discover new techniques, or are they only slight tweaks on existing techniques?
I don't know enough about machine learning to say that machine learning method A is better than machine learning method B. I think, speaking in very general terms, I think if there's anything out there that's interesting and novel, it's probably quite like non-linear. So what I'm thinking of is something like, I think you can probably do stuff with machine learning with relatively high frequency data, like pick up the footprints of big long-only funds like ETFs, rebalancing and stuff like that. I think you can probably, I think it's much harder to use standard methods, linear methods, to find those footprints in the data. Because you're looking for weird correlations. Like it might be that a particular fund spends a week every month rebalancing their portfolio, and it just so happens that they're selling this bunch of stocks and buying this bunch of stocks. That's quite a non-linear relationship. So I think you're more likely to see that with machine learning, and specifically with the machine learning technique that can find that kind of stuff. That's probably the most sensible answer I can give you without then having to read a book on machine learning first, which we haven't really got time for now. So.
So do you think we're pretty far away from AI and machine and coming up with lots of clever strategies? It's still a very human manual approach?
Well, humans aren't that great at coming up with clever strategies, to be honest. I mean, one of the interesting things about machine learning is, I guess, when it works really well, it tends to do what humans can do, but much quicker. So, let's take a useful example of machine learning, like looking at MRI scans and seeing tumors. This is something that skilled humans can do, but they have a high error rate and they're quite slow. That's the kind of thing that you should be directing machine learning at. Now, the difference is that there is actually a pattern there the thing's looking for. In the financial markets, there often isn't a pattern. Or if there is a pattern, it's something that we already know about or have found using classical statistics or have known about for donkey's years, which means it's really a risk factor rather than a pattern. It's something that we can get exposure to that will get paid for it. So yeah, I think it's these weird, like, non-linear effects that probably don't last very long, but if you can spot them before anybody else, you could make money out of them. That sort of thing, humans, there aren't probably that many of those patterns around to justify the number of people doing machine learning in finance right now, sadly. Ricardo.
I continue to like this picture. My problem is the portfolio optimization. Is equal weight that bad?
No, absolutely not.
Because suppose the pink line, with the concept that you use in your models, that is to add more data every year and to penalize the strategies that don't work. One day, suppose the pink line will start to pick up again.
Yeah.
If you use, after 40 years, it will take, the contribution will be 1%, 0.1%.
Yeah.
By the time your algorithm will wake up and say, oh, I want a piece of the pink line,
Yeah.
Maybe the best is gone.
Yeah.
Because the equal weight, yes, it is more robust than any other approach in your experience.
So, yeah. So,
I tend to simplify things.
yeah. So, speaking very simply, so you can understand, Ricardo. Essentially, at the start of, let's just pretend we're at 98. We start. So, if we have a really strong opinion that there are economic reasons or other reasons why the pink and the orange line are really good things to do, this goes back to, I think, the very first question. It would take a very long time for the data to convince us otherwise, probably. We probably wouldn't be convinced by 2016, 2017. If we were really that strongly convinced, even after 20 years of poor performance, we may have gone from equal weight to 0.9 times an equal weight. If, on the other hand, we assume we had no information. If we have no information at all about these strategies, either kind of subjective information or data, then equal weighting is theoretically the best thing to do. And then the data, what good optimization does is then say, how far away from equal weighting should we move given the amount of data we have? And the more data we have, the further it justifies it. And so if you had no view about if you had no subjective prior view about the strategies, then it may be that you, even here, would go down to maybe 90% of equal weight. If you had a really strong, you loved these strategies, but there's 20 years of evidence they're not great, well, you'll reduce your weight a little bit. If at the beginning you had no information about these strategies, you'd probably reduce your weight by more, but you still wouldn't be at zero. And so you'd be in a position to catch that bounce back. So, yeah. I mean, if...
More robust.
What's more robust?
Stands the test of time. Equal weight or all the other...
Well, there is... Okay, so I'm going to have to go a bit theoretical now. Basically, the equal weight works if all the assets in your portfolio have got the same volatility. Now we're doing risk targeting here, so that's a given. Secondly, if the correlation structure is boring, by which I mean all assets have the same correlation with each other. Doesn't matter what it is. And thirdly, if all assets have the same Sharpe ratio. Okay. So, generally speaking, and I've mentioned this before, you can't really statistically distinguish between assets with different Sharpe ratios. There tends not to be enough statistical evidence to say this asset is better than this asset. You need lots of long periods of time to justify that. But correlation is a different matter. So correlation is, there are good reasons to believe that regression 10 is very uncorrelated compared to regression 160. The correlation will be about 0.4. Whereas regression 160 and regression 113 have a correlation of about 0.85. So argue, and the nice thing about correlations is we can discover them quite quickly and that we can predict them quite well. We're quite good in finance at predicting volatility, going back to Arta's presentation earlier. And we're quite good in finance at predicting correlation. We're lousy at predicting returns or risk-adjusted returns. So basically what I'm trying to say in a very, very long-winded way is it depends on the domain. If you're in the domain of, say, let's say you're trying to allocate amongst the S&P 500 stocks, it's unlikely you'll be equal weight, to be honest, because it's automatically quite a diversified bunch of stocks. Although obviously some stocks are more correlated with others because they're in the same industry, overall the correlation structure is fairly homogeneous. The volatility is different, but not that different. The Sharpe ratios cannot be distinguished. So if you're allocating amongst a bunch of stocks, and unless you've got like a big industry weight in there, so like if you're allocating amongst 10 stocks and 9 of them are tech stocks, well, equal weight probably is a bit stupid. You know, you probably should naively put half your money into the tech stocks and half your money into the other stocks, something like that, or 60-40. If, on the other hand, you're in my world where what you're allocating amongst are either variations of a trading rule where there's very clear patterns in correlation, or alternatively amongst different markets where we know, for example, that US 10 years and US 5 years are highly correlated, US 10 years and Korean stocks much less correlated. In that sense, it does make sense to use correlations in your optimization. So yeah, I mean, for quite a lot of people, when they do empirical analysis of portfolio optimization stuff, tend to fall back on and they're just looking at stocks in the S&P 500 or whatever. And unsurprisingly, they find that equal weights does really well. Well, yeah, because that's the domain in which it works, but there are other domains in which you need to move away from it that a bit. This chap here.
Just on the previous question, I mean, there's an anecdote in the Wall Street Journal asked Harry Markets what used this PA.
Oh yeah, I love this anecdote. Yeah, it was 50-50, right? So the founder of portfolio theory doesn't use any of this nonsense. He just goes with Ricardo's solution of equal weight.
He didn't discover it for risk, clearly.
I think in theory this thing's supposed to finish at 5, but no one's thrown us out of the room yet, so I'll just keep answering questions until the lights go off. Yeah.
Can you give us a very quick?
But feel free to go, of course. I won't be offended.
As per your experience, stroke opinion, hierarchical breakdown in order of what you think are the most important factors that go into designing a strategy. I'm thinking things like fundamental factors, sentiment, market condition, costs.
So costs number one, definitely. And most people underestimate the effect of costs. There are whole swathes of markets I wouldn't personally trade because I think the costs are too high. Spot FX, sorry. But then I have the luxury of quite a big portfolio, so going back to what I said earlier, that's fine. The nice thing about this world is you're basically dealing with one kind of data, which is price data, and it's quite easy to do analysis with it and stuff like that. That you're limited, there's kind of an upper limit on how much money you'll make. You know, if I could hire 100 people, I've said this before, if I could hire 100 people, I probably would put, 3 of them working on sentiment analysis, and 3 of them working on this, and 3 of them working on that. But the nice thing about just dealing with price data is that it's very manageable for one person to deal with. You're not dealing with like 1,000 different data feeds. So, like for example, if you're working in like equity space and you're looking at things like accounting ratios, and you've probably got 100 assets minimum that you're trading, then you've got a lot of work for yourself. So, with infinite resources, yeah. My answer would be different with infinite resources, but in a general sense, there's kind of diminishing returns. So building so my system's got a back-tested Sharpe of 0.9, say. I could probably employ 100 people and push it up to 1.2. Would that be worth doing? Yeah, I guess if you're running $1 billion, then another 0.2 Sharpe is definitely worth doing. But doing the basics well is going to get you quite a long way up that curve, basically, is what I'm trying to say. And then as to what you do next, well, it's down to resources.
Is there a rule of thumb you have, like when you start plugging in more factors, where it becomes diminishing returns?
I've got a graph, actually, which unfortunately isn't in this presentation, but basically, so if you start with trend following and then you add, say, carry, which, again, Arthur was talking about briefly this morning, then you probably got 80% of the performance of a big CTA that's got 100 of these things. The better source of diversification is across different instruments. So if you have the money to do it, because you need capital to trade more instruments, you're better off trading 40 futures with one simple strategy than trading one future with 40 different strategies. And it's less work, because especially once you're automated, you can just roll out this thing to as many instruments as you like. But that's the advantage of running. I've spoken and written about this before. The main advantage a big fund isn't that they've got 100 people working on some fancy sentiment analysis. It's the fact they can allocate to 300 futures markets. So they've got a huge pool, plus a lot of OTC markets that retail traders can't even touch. So that's the big advantage that a big fund has. Yeah.
How effective is cross-validation for minimizing curve fitting? And if it is effective, can we not just increase the search space for finding trading practices?
I mean, cross-validation is better than doing nothing, right? It's better than doing in-sample fitting. So are you talking about cross-validation in the time space or in the instrument space? Well, let's say you've got 10 markets that you want to look at, and you've got 10 years of data. So you take the first 5 years and then the second 5 years. So strictly speaking, you're using a time machine, basically. Because what you do first is you take the first 5 years, fit your model, and test it in the second 5 years. That's fine, no time machine there. That's just in-sample, out-sample. And then you basically take the second 5 years, fit your model, and test it on the first 5 years. So from strictly speaking, you're using a time machine.
There'll be more partitions and you rotate.
So there are different ways of doing that. My favorite method of kind of temporal fitting is expanding or rolling out sample, because that to me most closely mimics what you'd actually do in reality. In reality, you'd start at the beginning and you know nothing, and then over time you gradually acquire more information, and you only use that historic information, but you in principle use all of it to fit your model that you run, and then in backtest I recalibrate every year, say. So you start off with no data, then after a year you can come up with a model which you then trade for a year, and then you've got 2 years of data then, and so on, and you move forward through time. If you're trading things that are likely to stop working, then you need to use a rolling window, so you only consider the last, depends on going back to your question, I said earlier, at this end of the continuum, you might be looking at something that's only worked for 3 months. You're not going to use 20-year backtest, are you? You're going to use the last 3 months and fit it on that, throw away everything else before. The thing about what I don't like about cross-validation is that I think it's really popular in the machine learning neural network space, principally because it takes so long to run these fits. So people can only be asked to do 2 fits. And then they think they're okay. They think, oh, brilliant, I've been really good. I haven't done any in-sample testing, and I've done 2 fits and then cross-validation. I mean, that's fine if you're in the regime of tumors on MRI scans, but if you use, say, the data from 2000 to 2015 to fit a model that you run backwards, well, firstly, you've got the time machine problem. Secondly, how do you know that this period, what does this? Let's say we're in the world where we're using shorter amounts of data. Let's say using the last 10 years of data. Well, the world's completely different in these 2 periods, so does it really make sense to cross them over? I've got slightly more time for instrument cross-validation, and that would be something like you fit on, say, let's say you fit on the S&P 500 and then test your model on all the other stock indices, say. I've got slightly more time for that, but not much more time. Yeah. Yes, you, yeah.
You mentioned you've got sort of maybe 10 or a dozen strategies. If you didn't have these, given what you know about markets today, where would you be looking for efficiencies or trading strategies? So if you had to start from scratch, not using your existing models, what markets do you look at and go, oh, I've got a hunch about that?
Don't really like the question. You were asking me to imagine a state of the world that just doesn't exist, so it's really hard for me to answer that. Maybe because I've got no imagination.
You don't look at the yield curve or something and say, oh, I could use Christmas.
Well, yeah, but I know about that already. You're asking me?
In terms of you know all the information that you don't have. The piece of tacit
Oh, if I was to, okay, let me rephrase your question to one I think I can answer that I think is correct. So let's suppose that you dumped me on a desert island and I had to create a trading strategy from scratch. What would I start? What would I start with first?
given you can't use one of the ones you've already got.
But I do, well, okay, but I have traded the yield curve in the past. So does that count? Am I allowed to use the yield curve or not?
Not the 10 or so you said you're actively trading now. So.
Well, I mean, yeah, I mean, okay, yes, equities are more work, but there's nothing wrong with, long-short equity. There's nothing wrong with options is quite a lot of work because you need to get evolved services and build them, but that's, that's a good area to do. None of this is like manna from heaven. These are all well-known ideas that everyone knows work, so, or have worked in the past. If I had to pick one of those, just one of those things. So this is funny, the whole time I've been here, I've not seen anyone holding up a sign with the time, and this guy's like, I want to go home, you have 0 minutes left. So yeah, sorry, I'm not really gonna answer your question properly. Instead, I'm gonna take one last question from the floor. From someone who hasn't asked a question before, which is this lady here.
So I'm a little bit scared to ask this one.
That's all right, I'm not gonna bite. Yeah.
Could you talk a little bit about the human or psychological side of running an automated trading strategy? Specifically, have you ever found yourself wanting to interfere? Have you interfered? If not, what's the secret?
Okay, this is a brilliant question. I'm really glad this is the last question. Okay, and then I promise you guys can go home, okay? But the answer to it is half an hour long. So the question was about the psychological problems of running a trading strategy. So I would say, in my experience, I found it harder working with other people's money, not to interfere. Because if it's your money, so basically, I have run my trading strategy, I've designed it, I know it intimately, and I believe in it. So if it loses money, and I also have a pretty good idea of how random stuff is. Yeah, so if it loses money, my first thought isn't, has this gone wrong? It's, oh, I appear to have lost money. Basically, I've just flipped a coin and it's come up tails. Some days I don't even check my P&L. That's how laid back I am about it. One way to achieve that is to not run with insanely high leverage, so to have a relatively modest risk target. And also another way of doing it is not to put all your money into your trading account, especially if it's your sole source of income. So someone said to me, you could make much more money in expectation if you put all of your money into a trading account. Because technically, you've got a Sharpe ratio backwards to 0.9, and you've got all these other investments that have a Sharpe maybe of 0.2. Why didn't you just do that? I'm like, well, if something went wrong, I'd look pretty stupid, and I'd have to get a job and tell my wife that we'd lost all of our money, and she wouldn't be super happy. So instead, I put a portion of my capital in my trading account, which if I lost wouldn't be the end of the world. And that pain point is different for different people. The risk target's also important. So even if I'm making I look at my risk in money terms, in my returns in money terms. If you look at it in percentage terms, it's easier to be dispassionate, I think. But the problem is I can immediately translate percentages into real money. So even if I look at it in percentages, it's still real money. And if I lose or even make an amount of money that seems too large in kind of money terms, then I know I'm close to the threshold of wanting of just worrying about it. So by setting my risk target and my capital at the point where a 5 sigma event, say, would make me go, but not panic, then it's okay, you know. So that's how I deal with that. In the professional world, you've got all these other stakeholders who don't know the strategy intimately, don't necessarily believe in it as much as you do, and who want to interfere with stuff. You've got stuff like, you know, this is a completely arbitrary example. This never happened to me. But it might be that just before the end of the calendar year, someone might say to you, oh, you should de-risk your strategy because we've done really well in this fund this year. We want to get this prize. And obviously everyone looks at calendar year returns, and let's not lose any money now, which from a theoretical point of view, you shouldn't do. But that's obviously a pressure and incentive. And I don't have that pressure at the moment myself. So full automation helps. I think if you actually have to physically do the trades, it's much harder. Yeah, running less risk helps. Having a strategy that, going back to the earlier point I made, that I at least understand intuitively. So even if it looks complicated from the outside, there's all these moving parts. Actually, each individual moving part is quite simple, and I understand them. And also, going back to the theme of the earlier presentation, explaining why something is making or losing money. If you have done the machine learning thing and you found this weird nonlinear effect, you may not really understand what's causing it, but you exploit it anyway. If it doesn't work, it's like, to me, that's like, well, okay, I didn't really understand why it worked. I don't really understand why it doesn't work. How do I know I've not just data mined this thing and it doesn't really exist? So I like to understand why I'm making money, where the effect's coming from. Yeah?
Thank you.
You're welcome. Thanks a lot, guys.